moving to Spain as an expat means more than just enjoying the Mediterranean lifestyle, tapas and siestas. It also means understanding how the Spanish tax system applies to you, whether you are relocating for work, planning or retirement, or maybe returning after years abroad. Your tax obligations will depend on your residency status, income, and assets. Spain offers certain reliefs and incentives, but also has some strict compliance requirements, particularly when it comes to reporting foreign assets. This video outlines the key taxes expats face in Spain, from the income tax, wealth tax, to capital gains tax and property taxes, as well as important rules such as the Beckham's Law and the Modelo 720 Declaration. The first question we're going to discuss is when expats have to pay tax in Spain. Of course, once you arrive in Spain, you must register as a taxpayer by obtaining a NIE, Número de Identificación de Extranjero, Spanish, within 30 days. Both residents and non-residents are subject to Spanish taxation, but the scope differs. Tax residents are taxed on worldwide income and assets, whereas non-resident taxpayers are taxed only on income and assets located in Spain. Understanding where you fall is the foundation of expat tax planning. When it comes to the residency rules, when you actually become a tax resident, I have the following points to say. Spain considers you as a tax resident when you spend more than 183 days in Spain within a calendar year, consecutive periods or not. When your spouse or dependent children primarily live in Spain, you are also deemed as a tax resident. Or when your main business or professional interests are located in Spain. If any of these above categories apply, you will be taxed on your worldwide income. If not, you remain a non-resident and you are only taxed on income sourced in Spain. I'll now be talking about income tax for expats. Spanish income tax, known as IRPF, Impuesto sobre la Renta de las Personas Físicas, is a progressive and split between the state and the autonomous community of where you live. Rates differ slightly depending on the region. Typical resident tax brackets are about 19% for up to around 12,000 euros in income, all the way to approximately 45% on income to, or rather above 60,000. And there is a special tax bracket for income over 300,000 euros, which is 47%. Residents also benefit from personal allowance, which is about 5,500 if you're under 65, about 7,000 when you're above 65, and it goes up to 8,000 if you're 75 years or older. Non-residents, however, on the other hand, pay a flat 24% on Spanish-sourced income, which is lower to 19% for EU citizens, but they cannot claim deductions or allowances. The Spanish tax year runs from January to December, and tax return should be filed between April 11th and June 30th of the following year. Now to talk about the wealth tax and the solidarity tax. Spain levies a wealth tax on residents' worldwide assets and non-residents' Spanish assets. Residents generally receive an allowance of about 500,000 to 800,000 euros, which all depends on the autonomous region they are a resident of. Non-residents get a flat 700,000 euro allowance. Homeowners can also deduct an additional 300,000 for their primary residence. If your assets exceed 2 million euros, you must file a wealth tax declaration. Rates are progressive, starting around 0.2% and can rise to over 3%. Since 2003, there's a solidarity tax for very wealthy individuals. This is a solidarity tax on net assets above 3 million euros. Rates mirror the upper wealth tax bands, 1.7% to 3.5%. Any wealth tax already paid is credited against this bill. This ensures no double taxation. Capital gains tax, CGT, applies to profits from selling assets such as property, shares, or investments. For residents, the tax brackets are 19% up to 6,000 and can rise to about 26% for over 200,000. For non-residents, flat 19% on Spanish-sourced gains. Exemptions may apply, of course, particularly for residents selling their main home, especially if reinvesting in another primary residence or if you're over 65 years or older. Expats returning from tax-free jurisdictions should consider disposing of assets before repatriation to avoid unexpected CGT bills. Now, about the property tax. All property owners in Spain pay IBI, Impuesto sobre Bienes Inmuebles, a municipality tax calculated on the cadastral value, administrative property value. Rates typically range from 0.4% to 1.1%, depending again on the local authority. Additional property-related taxes include 10% VAT on new property purchases, stamp duty on purchases, which is typically around 1.5%, and property transfer tax. And again, this varies per region. Renting out property in Spain also generates taxable income with deductions available for Spanish tax residents. There is also inheritance and gift tax in Spain. The inheritance and gift taxes are payable in Spain regardless of residency. The rates depend both on the value of inheritance and your relationship with the deceased. Spouses and direct descendants typically receive lower rates or allowances, but rules vary wildly between regions. In some areas, such as Andalusia, generous exemptions mean many family transfers may even be tax-free. Now to touch on some key tax laws for expats. Beyond the standard taxes, there are 3 important rules expats should be aware of. Firstly, to start with the Beckham's Law, a special expat tax regime. This was introduced in 2004, and the Beckham's Law allows qualifying workers who relocate to Spain to be taxed as non-residents, 24%, for up to 6 years. This flat 24% tax rate on employment income goes up to 600,000 euros. There are reduced rates on dividend income, interest, and capital gains. This regime especially is attractive for highly paid professionals compared with progressive resident tax rates. Second would be the foreign asset reporting, the Modelo 720, because residents with overseas assets worth more than 500,000, or rather 50,000, must file an annual Modelo 720 declaration, which includes bank accounts, property, shares, and insurance policies. Failure to report can lead to severe fines and possible criminal charges. While holding foreign assets is not taxable in itself, reporting is mandatory, and income may be taxed depending on your circumstances. Third and last would be the 30-day rule. For non-EU citizens, Schengen rules limit stays to 90 days in any rolling 180-day period without visa or residence permit. Staying longer may trigger tax residency obligation, so please align your immigration status with your tax planning. And lastly, some practical considerations for returning expats. Many expats moving back to Spain underestimate the complexity of repatriation. Changing from non-resident to resident can dramatically increase your tax liability, particularly if you hold property, large investments, or global income streams. Careful planning, such as timing asset disposals, structuring wealth through allowances, or making use of the Beckham's Law, can make a significant difference. The key takeaways of this video is that residency is important to understand because residents pay taxes on global income, whereas non-residents only pay their Spanish income tax on Spanish sources. The income tax is progressive, ranging from 19% to 47% for residents, or a flat 24%/19% for EU non-residents. Wealth and solidarity taxes apply to high net worth individuals. And of course, lastly, capital gains are taxed at up to 26% for residents or 19% flat tax rates for non-residents. Property, inheritance, and gift taxes vary widely regionally, making local tailor-made advice important. Please reach out to me in case you need such advice. Beckham's Law and Modelo 720 are important to understand for expats. If you want further information on that, again, please feel free to reach out to me.